Good afternoon, everyone. Good evening. The last time we were here, for those of you who joined us last time, it was late January. It was dark outside, and we were still in probably a little bit of a lockdown hangover. So welcome back. It's obviously a lot brighter outside. It's our special spring edition, and we're very lucky to be joined by Lucy, who's from Horatio's Garden. But before we move on to that, a lot's going on in the investment markets, as we know. There's loads of headlines out there, mostly negative, occasionally positive, but mostly negative. So the way we're going to run through things today is we're going to give you a little bit of news and the stories behind the headlines and the positive news behind the often negative headlines that journalists write. We're going to kick off today with Julian. Julian is going to spend a few minutes going through our current thinking, update us from where we were last time, and spend a little bit of time on his thoughts. Then we're going to hand over to James, and James is going to go through what we've been doing on our portfolios, on your portfolios, what we've been buying, what we've been selling, why, and the so forth. And then we're going to hand over to Will, who's going to have a little bit of a look at the outlook, look at the positive long-term drivers that we see, and indeed put it all together and round it up. We will have Q&A along the way. The chat room, for those people that have used it before, down the bottom is open, and myself, Will, James and Julian will be handling questions if you have questions along the way. So please do file them in. Any we don't get to, we will we'll respond after the session. We're going to take about an hour of your time. We're going to spend about 30-35 minutes, maybe a bit more, maybe a bit less, before we hand over to the star of the show, which is Lucy from Horatio's Garden. Horatio's Garden is a charity based in Salisbury. I won't steal your thunder too much, Lucy, I promise. And we work quite closely with them. We've done a number of events with them. We've done a plant sale and bits and bobs. We did a Land's End to John O'Groats virtual walk during lockdown for the Horatio's Garden to help raise funds. We're planning a Clarendon Way walk this summer between Winchester and Salisbury to raise funds, and then I think myself and James and maybe a couple of others are planning a bit of a longer bike ride from Salisbury to Paris to try and raise some funds for the very good work that Lucy and her colleagues do at Horatio's Garden. But more from that, if I haven't stolen too much your thunder, Lucy, apologies about that. More of that from Lucy in a minute. So without any further ado, over to Julian. Now I'm going to share my screen, Julian, if that's all right. So just tell me when to drive, if that's okay, sir.
Great, lovely. Thank you, Matt, and good evening, everyone. Let's just go on to the first slide. Thank you. So there certainly is, a lot of, cautious noise, what we're hearing in the media at the moment. I think since we sort of last spoke back in January, I think that sort of COVID risk has now been replaced by sort of other risk around sort of inflation and obviously geopolitical events. I think those who were with us last year, I mean, really for the last, 18 months or so since we've been doing this, we've been pretty upbeat, even during some of the sort of the quite cautious days, middle of COVID. We always felt we would get through the events, and our portfolios were positioned accordingly. This is the first time we've perhaps become a little bit more cautious. I don't think, I'd hope it's not a particular surprise for people. So just this sort of negative scenario in the sort of the short term. So really we're looking over sort of the next sort of 3 to 12 months. We have just sort of nudged that up, and what we're calling sort of the muddle through, we've just nudged that down. Overall, we're still optimistic that we will get through, what's going on. But I think it's just, those negatives. I don't want to focus on the negatives, but I think that's what probably is on people's minds at the moment. Obviously, we have this ongoing situation in Ukraine. There's not an awful lot I can add, so I'm not going to get too much into that. Got this concern about rising inflation, which I'll sort of come back to in a moment. But that's principally around sort of, what we're seeing in food and energy. Obviously, the issues we're seeing in Ukraine is adding to this, rising energy prices, oil's well above $100. Probably not much chance of it coming back down, certainly in the sort of the short term. So there's always that potential we get some sort of spike upwards, which is obviously going to be unsettling. I think we've had literally a few days ago the Bank of England governor using the words apocalyptic with regards to food prices. I don't think that's terribly helpful. It may be perhaps what people are feeling a little bit at the moment, but I'll sort of come back to this. So I think this is people's biggest concerns. And I think lastly, you know, also we're seeing it in China, you know, they've been very severe in terms of, sort of locking down again. Does that sort of risk, you know, virus spread around the world again? I think, you know, that's generally off the radar. So I think it's really focusing on sort of inflation and this sort of geopolitical risk. But I think longer term, you know, we still remain upbeat, and Will and James will be talking much more about that. So really for this, my sort of slot of, you know, 6, 7, 8 minutes, I'm just going to really focus on these sort of couple of main concerns and just try and put some context on this. Next slide, please. So I've only got a sort of couple of busy slides to talk about. So just what I'm trying to illustrate. Now this goes up to the end of March. The numbers have changed a little bit since, but just really on the left-hand side, you know, I'm going to talk about inflation first, because that is what's grabbing the headlines. So the left-hand side talks about the US, the right-hand side talks about the UK. So in the US, we've currently got inflation running at around sort of 7% or so. In the UK, again, 7-8%. But now the Bank of England is saying that inflation could be 10%, you know, by the end of this year. And really, what we're just trying to show on here, probably it doesn't matter too much which line you focus on, but the black line is really trying to indicate, you know, what's the expectation, you know, in a year's time. And then the blue line on both charts says, you know, it's almost a 5-year expectations. And I think really the important thing is, you know, if we just focus on the right-hand side for the UK, as much as the Bank of England and the media are sort of focusing on this sort of 10% number, really in a year's time, what the markets are saying, and bearing in mind, this is hundreds of thousands of investors, you know, professional investors getting together. This is how we price markets. They're saying we should be at around 4%. So I think that's the first thing which I just wanted to reassure everyone this evening, is that, you know, to some extent, I wouldn't say ignore the headlines, but we know that the headlines can often exaggerate, you know, it's a worst case. And I think it's then important, what we're trying to do is sort of take a step back, look at, you know, what's the evidence, step back from the noise, you know, what's the evidence. So really, I think it's looking sort of close to 4% is a more realistic number going forward. If we then go on to the next slide, leading on from this is then interest rates. So whether you're running a business, whether you're looking at a mortgage, whether you're, obviously for us, when we're pricing different asset classes, you know, what are markets saying about interest rates? So if inflation is going to be peaking or certainly rising to around 10% in the UK, and hopefully that's short term and it peaks, but actually what are we looking at longer term? And again, I'll probably just focus on the light blue number. So looking sort of 1 year out, interest rates going from this sort of 1% to around sort of 2.25%. Still very low. So it shows that the Bank of England is having to be quite careful about raising rates too aggressively to choke off this inflation. Because inflation is not coming from sort of too much demand, it's coming from these supply issues which we've got across the world, food and energy, etc. So just putting up interest rates is not going to bring down, you're not going to help the supply issue. And if anything, it might actually hurt the demand side. So they want to keep demand strong. And then hopefully the inflation sort of passes its way through the system. So hopefully that can be sort of, you know, again, provide some context, but also reassurance, you know, for sort of, you know, for all of us, it's what we're looking at, but for you as clients, investors, business owners, you know, what are markets talking about with interest rates looking further out?
Julian, sorry, can I ask a quick question, maybe to clarify something? And that is, so the Bank of England would normally put up interest rates if demand was being driven by everyone becoming more, having more money, spare money, and prices being pushed up that way. That's the way the bank would normally control inflation. Am I right? This is, like you say, from the fact that everything's going up. So everyone's poor already because the fuel, food, energy, etc. is already more expensive. Is that right?
Yeah, so the problem is because of that inflation, we're all sort of feeling the pinch. If anything, that means we're going to be spending less. So that means this almost causing a dampener on the economy. And the Bank of England would be aware of that, which is why they don't want to be too aggressive in putting up interest rates. But on the other hand, they've also been, it's called, you know, getting behind the curve. Inflation has been moving up. You know, we've been in effectively emergency rates for a couple of years now, and they've been quite slow to get out of that and sort of try and control this inflation. So that's why the markets say about being behind the curve. They need to catch up because they should have probably acted sooner, but they've now seen this inflation and they can't control inflation when it's coming from this sort of supply shock. And then obviously with this conflict in Ukraine, that's just made it worse. But I think, some people have been saying, well, actually, is this inflation shock because of Ukraine? Well, no, because inflation was at 7% even before this conflict had started. So it was already a problem caused by this sort of rising demand, and that should have then passed through quite quickly. But it's the conflict which is now sort of dragging this inflation, increasing it, but then sort of dragging it out a little bit longer. But hopefully I've just tried to show with these charts, it then pass through, and then inflation comes back down, interest rates come back down. And obviously that's from the investment perspective, that's what we're looking at when we're looking about how we invest.
Thank you.
If you just then go on to the next slide. And then just the last quick sort of chart from me. Again, trying to put some context, some sort of positive around obviously what's a lot of negative at the moment. I'd probably focus on the left-hand side, we're looking at sort of consumer confidence. So again, if we go back to sort of 07, 08, 09 crisis, or even back to the beginning of the COVID outbreak, you can see how much consumer confidence really plummeted. But this time, yes, it's falling, but not back to those lows. But I think perhaps the more important of the two charts here is about the housing market. So again, previous crises, you often see housing fall very quickly, sort of lack of confidence or availability of money. But actually this, out of all my charts, I'd say this is perhaps the most reassuring. The housing market generally is holding up very stable. And we're seeing this in America as well. And actually in certain areas, actually the housing market's been quite buoyant. So I think, again, what you often you've got to look at an individual's overall wealth, so yes, they may have investment portfolios, but housing is often a big part of their overall assets, as long as that housing market can remain stable, which again is another reason why perhaps the Bank of England doesn't want to put up rates too aggressively, which might sort of impact the housing market. So again, I think just another slightly reassuring number just to sort of share with everyone. And then just the next slide, and it's the last one for me, really just to wrap up before we pass on to James. Just to sort of summarize and say, yes, we've still got these economic tailwinds, remain positive. We're coming out of COVID, whether it's businesses or individuals, there's a pent-up demand. Demand generally is solid. Yes, we've got some more headwinds now to contend with, but most people should have some relatively, high savings rates. Been saving money over the last couple of years. We've also got very low unemployment, which again is reassuring for the state of the underlying economy, as well as things like the housing market. Yes, inflation is a concern. We will see rates rising, but as I've just shown, hopefully not too aggressively. But we also do need to monitor these sort of geopolitical risks. And I've mentioned this now for several of these sort of video updates about sort of confidence in governments and central banks. That is important for markets, because obviously that's where we're investing. So, just to sort of, in summary, and obviously then James and Will talk about this a little bit more, alternatives remain attractive, equities still remain attractive. The UK has actually held up very well, but that's mainly with some of the sectors which we've got, which we'll come on to in just a moment, and also looking at real assets. So I think that's one sort of final comment. Even though there's, inflation can cause problems, there are also sectors and companies and areas of the market where we can invest in, and we are investing in, which are actually benefiting from this. So yes, some parts are being impacted negatively, they're being hit, but there are also areas where we've been rotating into other parts of the market which are actually benefiting from this, so whether that's around inflation or supply constraints. But James and Will talk about that more. So that's it for me. Thank you.
Thank you, Julian. So without any further ado, I'll hand over to my learned colleague, Mr. O'Hara. James, over to you, sir.
Thank you, Cheeky. Yeah, good evening, everyone. Hope you're all keeping well. As Cheeky said at the start, I'll be taking a walk through the bespoke activity in our portfolio since we last met back in January, and I'll be working in tandem with Will, who's got the enviable task of trying to find the green shoots in all of this red that we seem to be seeing in the news flow at the moment. But if you wouldn't mind just popping to the first slide, Cheeky. On our last meeting, we discussed these 4 factors, and they're very much still relevant and challenging us today. You could argue COVID is slightly waning, definitely over here, but obviously when you look out in China, it's definitely still something to consider. And considering it took out 80% of our staff meal at our end of COVID restrictions party, that was certainly a humbling on our end, and it shows that it's definitely still something to contend with, and I'm sure you'll see the irony there. And then if you flick onto the next one, Cheeky, moving into sort of late February, a certain Mr. Putin decided to invade neighboring Ukraine out in the east, and that's a conflict that unfortunately is still rumbling on despite everyone's best efforts. And this event really disturbed the markets for a couple of weeks until a lot of the bad news was priced in. But the secondary effect that had, aside from sort of obviously the human atrocity, is the throttling that's had on supply chains. Obviously, we felt the pinch ourselves with the energy crunch, the prices going up, prices of food are going up, and obviously the inflation that's caused, and then the subsequent effect on that is central banks' reactions, and can they navigate us to a soft landing without killing demand, which obviously we'll go into a bit more. But that sort of tightening liquidity is what's really given us this volatility in the last few months, and there's especially been a bit of a divergence between sort of share fundamentals and share price, which again we'll allude to a little bit more. But my job here is to go on to go through some of the things we've actually been doing in portfolios. So you might pop into the slide, and I'll just talk about what we've sold over the last 3-4 months, starting with Allianz in the top left. That was our corporate bond fund. There was a bit of contention whether we wanted to class that as a corporate bond fund or an alternative. We did eventually reclassify as a corporate bond fund. That made that a bit of a compliance issue. We were overweight corporate bonds. The fund itself had exposure to derivatives, and if we want corporate bonds, we still want something slightly more vanilla, that we know exactly what's going on under the hood. There was a period of poor performance, and we sort of lost conviction with the manager and that derivative activity. So we found a better alternative and decided to sell that. Imperial Brands was one of our 2 tobacco holdings. We sold on management uncertainty. We were looking to sort of reduce on an ESG basis as well. And after they cut their dividends, we saw this as an opportunity moment to sell out, and we did the analysis ourselves, and we still hold British American Tobacco, which we thought was the more favourable holding, and they've got a better pipeline, and all their e-cigarettes, which is obviously a lot up and coming with all the kids and trying to be healthier smoking, if that's a possibility. And Allspring in the bottom left was our emerging markets funds. We sold this just sort of at the outset of the conflict of Russia-Ukraine. It was an easy way of sort of reducing our equity exposure. We were concerned about the contagion of the war going to sort of China and Taiwan, and considering the fund was fairly exposed to those 2 countries, we thought it was a good time to get out, and our decision has been vindicated. Obviously, the performance has not been great, but neither has any EM funds, particularly because the US dollar has been so strong, and that historically hasn't been good for our EM funds. And Kraft Heinz has been on our sell list for a while. We felt going into a potential recessionary period, tighter margins, consumers' pockets are going to be pinched, and people might be shopping down, so they might not be getting their Heinz beans, they might be going to Branston or even Aldi or Lidl. And as we sold into some market strength, then thankfully, after the last couple of days, that's really sold off, because I think the inflationary pressures are really showing on their earnings. If you wouldn't mind flicking to the next one, Cheeky. Thank you. And then JP Morgan, we really wanted to increase our financials exposure, another one we've been stalking for a while, and sort of a weakness around the January period allowed us to get in. Looking forward, we wanted something that would really benefit from policy tightening, and banks do really well when in periods of rising interest rates. They're a global leader, very strong financials. They've survived obviously the 2008 crisis. They've been through things like this. And of course, looking into the future, they're investing a lot into sort of fintech to stay nimble and stay relevant, which is obviously something we look for in our shareable technology. So we're pleased to get hold of that. AstraZeneca has been a hold for us before, but again, we sold because we thought it was too expensive at the time. It's since come back into range. Healthcare has always been one of our key themes. We think all of us are going to stay or get older and stay healthier for longer, and we're going to require healthcare, possibly more private healthcare when we get older, and companies like AstraZeneca are set to benefit from that, and we have a really good pipeline in terms of oncology and curing cancer and rare diseases. So we're pleased to get in, and we did, and obviously that's done really well for us since we bought it. L'Oreal, another one that we've held and sold on valuation grounds a few years ago. It was just too expensive at the time, and then obviously we've had a chance now into this period of tightening. It's since come back into range, and we think they're going to turn around their business. China is still strong despite the lockdowns, and we still think that L'Oreal brand people, despite in the recessionary period might not have as much money, will still want their nice shampoos. Obviously, you need the little things to make you feel a little bit better when times are bad. And then Beazley's is a recent purchase that some of you guys might not have heard of, but it's an insurer and a reinsurer, and we wanted to again bolster our financials exposure. But the interesting thing with Beazley, it does a lot of cybersecurity insurance. And that was something we didn't really have a lot of exposure to in the portfolio, so we're excited to get that. And obviously with cyber premiums going through the roof, I think it increased 100% in Q4 2021. And like a recent study of sort of CEOs, I think the thing that were most likely to be kept in terms of spending for companies was that cyber element. So we saw it was an opportune time to do it. And again, that's really performed well despite all this negative mow we've had in the markets recently. If you pop over, Cheeky. Thank you. And then Lazard and SMC. So this completes our Japanese weighting. So we spoke about last time, we added Nintendo and another company, Mitsubishi Gas Chemical. So we've got conviction in that area, and we think that Japan really offers something that you can't really get in UK and European markets. It's got a lot of technology and innovation there. Lazard is just the active fund. We've been looking for an active fund for a while that really complements sort of the growth here, direct stocks that we have. And we met the management, and we really like their sort of value-centric look, and they really invest like we do. So we're pleased to get that on board. And SMC, probably a lesser known stock, but that was our final exposure to Japan, and it really falls into the pick and shovel theme. They basically do sort of pneumatic engineering and innovation and automation in Japan. Adco is a recent purchase. Obviously, we rolled straight out of Kraft Heinz into Adco. It's a smaller American company just with a market cap of 10 billion. But why we're excited about Adco is that they are an agricultural technology company, and seeing what we're seeing out in the east, and obviously all the crops and fertilizers that aren't being able to be transported across the world because of this. Adco, actually one of their subsidiaries is a company called Precision Ag, and on their big combine harvesters, when they're sort of fertilizing the fields, they use a lot of AI and technology that basically enhances the efficiency of all of that. After going into a world where supply might be in short, there'll be a lot of demand and not enough supply, it's going to be important that that efficiency is really there. So we're pleased to get in when we did. And Sixth Street Lending, which is one we've probably been stalking the longest, is a US investment trust that provides lending to high growth companies in the form of floating rate notes. So like a variable mortgage, floating rate notes in times of rising interest rates will go up with interest rates. Obviously that's not good for a mortgage, but it would be good for us with these floating rate notes. Obviously it yields about 7 to 8%, which in this environment is not to be sniffed at. And then our final purchase to discuss this period is Google, one we've been stalking for a while. This has been a strategic hold for us in our high net worth portfolios since our inception. Obviously, we've been discussing our move to sort of global portfolios in the last sort of 12 to 18 months. So we're now looking to add it and have added it for everyone. They've been hurt in the recent sell-off, looking extremely cheap, and they're a cash generative machine. Obviously, the Google search and advertising that brings in, but also YouTube, and that as a massive form of media. It's not just when you go to look up someone building IKEA furniture, there's full series on there now akin to that of Netflix. And whilst we've seen disruption to some of the fangs like Facebook, now Meta, and Netflix obviously really struggling, I think Google's really going to remain one of the generals there. So we're pleased to have finally got that. And then finally, just a few top slices that we did. This was back also at the outset. BAE Systems, they obviously do armaments and munitions, so there's an element of textbook investing. It went up 15% in a day in response to sort of Putin's sort of militarization of Ukraine. So we took the opportunity to just really lock in some profits there. And we've obviously thought it's just traded sideways since then, that possibly all the bad news is priced in, and obviously bad news is good news for BAE Systems. So we're looking to review that for a possible full sale. And then BP and Shell, this is something we've been harping on about for a long time. It's been a hold, and we've been buyers ever since everyone thought we were mental buying these during the depths of lockdown. And we've kept adding to it, and it's been, those two have been probably our best performers over a year. So obviously with the throttle and the rising oil price, BP and Shell and just printing money at the moment. So we've decided to, on a risk adjusted basis, we can't let the positions grow too big and position sizes grow too big in portfolios, so we decided to lock in some profits then.
James, sorry to interrupt. Could
Yeah.
you possibly just expand on what, or describe what top slicing means?
The top slicing is obviously we have the default weights in portfolios, and then as the share price grows, obviously that weight in the portfolio grows. So over time, those positions will be overweight. And if we see, as with these two here, that the thesis is the same, but we think on a risk-adjusted basis, we'd like to lock in some profits, we will just trim that extra weight back to the way it would be in portfolios. And that's what top slicing is really.
Thank you, sir.
Way of locking in profits. But yeah, and that concludes the whistle stop tour. Over to Will now for what next.
Thank you, James. Just to let everyone remind everyone in the seminar that the Q&A function down the bottom of the screen is open. So if you have any questions for Julian, James, or Will, or indeed Lucy when we get to it, please do fire them into the Q&A bit. No such thing as a silly question, as you've seen by my two questions already. So fire away. Over to you, Will. Thank you, sir.
Great, thank you, Matt. Good evening, everyone. And as you've heard today, I'll be summarising our thoughts on, what's ahead in the economy, the markets, and how we're actually looking to position ourselves through the bespoke portfolios that invest directly into company shares. So, as you've heard, there's no doubt that markets have been extremely turbulent over the last few months since our last investment briefing back in January. And whilst we did anticipate that it was likely time to buckle up and we did see some gathering headwinds, it's certainly been a lot bumpier than we'd expected. And that's no less because of the sudden invasion of Ukraine by Russia. So, as you can see here, these events, we've seen this wall of worry build, and it seems like the bricks have been added constantly over the last few months. And our markets normally like to climb a wall of worry, but this has certainly got really quite high. As I say, we've had we'll have the war in Ukraine that's resulted in the spike in oil and gas prices. Also, the zero COVID policy of the Chinese authorities that really continue to hamper global supply chains. And as you've been hearing through this session, the biggest effect is inflation, and that's what we're really starting to feel. Whether it's at the petrol pump, we're seeing it in our utility bills, or even really starting to feel it in the grocery basket. So right now, as I say, the wall of worry is really built up quite high, and it's very clear that investors have become more and more uncertain as to what's on the other side of that wall of worry. And certainly as markets and indeed the news flow just focuses on the negatives and has completely forgotten that there may well be some positives out there. And that's not to say that, there's no doubt that we are definitely going to go through some tough times ahead. But as I'll highlight, I think we definitely need to start to look out for some of those positives. So if we can go to the next slide, please. So with all this uncertainty, we find the markets reacting on emotion rather than fundamentals, which means that there's been a real disconnect between the stock market pricing and the state of actual companies in the real world. And let's not forget that if we look at the results at the moment, good quality companies are still reporting positive financials, although they are slightly tempering down the outlook for their businesses going forward. It's not Armageddon, certainly not from what we're hearing. But despite this, markets have been trying to price in every single piece of negative news and the worst possible outcome. And this emotional selling is certainly gut-wrenching. But Keith, Julian, myself, we've been investing in these markets for the last 25 to 30 years. And really, we see many of these instances play out to roughly similar patterns. And this chart sort of details that quite nicely, kind of showing the emotions that capture investors' imaginations during such periods. Now, no one can really predict 100%, when markets are going to bottom. Or when we're going to get to that level. And there may certainly be some time before we get there this time around. But right now, we're beginning to feel that we're getting to the point that so much negativity has already been priced in that would only really take a few of the factors to go right for the market to begin a recovery process. which, don't get me wrong, could certainly still be quite bumpy, but eventually head in the right direction. So on the next slide, we'll take a look at what we're watching out for to signal a turning point. So as we mentioned, the markets are ultimately looking at three major concerns: inflation, central bank policy, and of course, recession. Now, what we're looking for are those signs that the factors feeding into these worries are really beginning to turn positive. And it may well be slow to start, and we may also get some false starts. But as momentum gathers, and it will, the data should gradually improve, and we should start to see some of this fog lifting from the current uncertainty, which we expect should be enough for markets to eventually resume their climb up that wall of worry that you saw a few slides before. Now, of course, an end to the war in Ukraine would be a major positive, and would very likely see some relief to the oil and gas pricing pressures. Also, the end of China's zero COVID policy will eventually bring relief to the world's supply chains. And this is really such a draconian policy that they've brought forward. And we're already starting to see people begin to rebel as their conditions worsen to the point of desperation. So we're looking for, and we're actually beginning to see signs that this should end quite soon. Another factor caused by lockdowns was the so-called Great Resignation during the latter stages of the pandemic, as furlough and other emergency measures saw people's savings increase and tempted many people to actually leave their jobs and not to return to the workforce, just as economies were moving to reopen. So we're looking for those early signs that people are beginning to re-enter the workforce, which at the moment is very tight. And this should eventually moderate the threat of any sort of spiraling wage inflation, which certainly can be hard to contain once out of control. So early signs that inflation has peaked will be key to watch out for. And certainly there are signs that people are really already starting to tighten their purse strings as retail sales numbers are coming in now. They're still slightly elevated, but they're beginning to come in slower than expected, which is actually a positive sign at this point. So it should lead to a closer balance between supply and demand for goods. We're also starting to see signs of this moderating trend in the commodity markets as prices of copper, lumber and iron ore have really begun to calm slightly. Now, unfortunately, as we all have seen, this doesn't yet include oil, gas or wheat, as they're still really being driven by the war in Ukraine. But this is all starting to filter through to some of the gauges that we're looking at. And one of them is actually the inflation expectations, which very, very recently, in the past week or so, although still elevated, has started to moderate. And long-term interest rates have begun to come down to, I would say, less alarmist levels. So markets do seem to be doing quite a bit of the hard work for central banks, gradually lowering inflation and hopefully without an all-out assault on short-term interest rates, as we saw in the 1980s. When interest rates soared up into the teens and beyond. So all in all, if this trend can continue and the markets begin to sense that inflation is not out of control, but don't forget that actually governments do want a slightly higher level of inflation to help erode the massive debt piles that they're now sitting on. But if it's all shown to be in control and stable, central banks, we hope, don't have to be too aggressive with their interest rate policy, and that immediate threat of a nasty, deep recession can be removed. Now, certainly more data is needed over the next few months before we can really tell whether or not these trends are going to stick or not. So if we could go to the next slide, please. So what are we doing about all this in portfolios? Well, as you've heard from James, we've been busy working hard through the last few months, making sure portfolios are well positioned for what lies ahead. And over the last few weeks, we've seen markets really begin to throw in the towel on many companies. But they've also ignored the state of many high quality companies. And it's this detachment, as I've said, between business fundamentals and the stock market that creates the greatest opportunities for the long-term investor. And we here at Casterbridge really focus on exactly those fundamentals of businesses that we invest in. So here I've just highlighted some of the important factors that we look for in those companies that we look to buy. Where we're looking to invest in, as I say, high quality names with excellent financials, ensuring that they don't get into financial trouble when there are short-term difficulties. We're also looking for those companies that have been making good profits and that they have good profit margins, ensuring that they have some capacity to withstand the increasing cost pressures, as we're starting to hear from many companies out there. We also like those companies that have the ability to pass on some of those inflationary costs onto the end user, which will help provide that buffer against inflationary pressures. So at this time, we really believe that portfolios are in pretty good shape. However, there are always interesting opportunities that pop along that sort of tie into our core long-term themes that we look at, and when the price is right, we'll look to invest in. And just to give you a flavor of some of those ideas that we have at the moment, we're still looking to bolster up our financials exposure, specifically through a private equity management company where investors can benefit from private equity deals without any of those long-term tie-ups. And this is actually quite an exciting time for private equity firms as they have cash to deploy. And with markets at such an oversold position, we'll likely see more private equity activity over the coming months and years. We also still like technology. And one realm of technology that we're looking at is cybersecurity. And this is an area that is expected to really continue to thrive for as long as the internet exists. And hackers are becoming more sophisticated, and increasingly they seem to be rogue state sponsored. So these cybersecurity companies are becoming more and more important, and really as their responsibility is to protect so much of the world's infrastructure, businesses, and even us, the consumer, from these hackers. So we're also looking to increase our exposure to emerging markets. So you heard from James that we sold one of our funds, and now we're looking to roll back in as we feel that emerging markets have certainly participated in this downside that we've seen. Now we're looking at good, excellent medium to long-term opportunities to get back in. And these emerging markets have very attractive structural factors for growth over the longer term. And finally, as always, it's important to point out that we take a diversified approach to investing, providing you guys the exposure to the best companies in the world across sectors. So if we can move to the next slide, please. So to close, I hope you can see that as we navigate through these turbulent markets, we have been and will continue to keep calm and stick to the long-term plan, as we find these periods of volatility have always over the decades presented us with exceptional medium to long-term opportunities. And to highlight the importance of not panicking and selling up during these periods of market decline, we have here some data of market moves from 1986 through to May last year. And really to highlight the value of staying invested even through these troublesome periods, given the risk of not fully participating when markets do eventually turn upwards again. So in this analysis, by just missing the 10 best days over this time period, an investor would have missed out on just over half of the upside. So rest assured, we believe that we're positioning portfolios well to weather the potential short-term storms ahead, whilst making sure portfolios work hard for you over the medium to long term, especially during these periods when we're able to pick up really high-quality companies that have suddenly gone on sale. So that is me done. Thank you very much for listening. I'll pass it back to Matthew.
Sorry, I was just unmuting myself there. Will, thank you very much indeed. Right, now for the star of the show, I'm going to hand over to Lucy from Horatio's Garden. So Lucy, over to you.
Hello. Hi everyone. So Horatio's Garden, yes, we are based in Salisbury in terms of our head office, and we started in Salisbury 10 years ago, but we're now a national charity, and we have gardens at NHS spinal centres in 6 hospitals, and we have plans to go into all of the 11 spinal units, so we're not stopping there. We create and nurture beautiful gardens, which are for the patients and families in the spinal units. So what does that involve? Well, that involves us creating a garden which is going to be there for the long term, And it involves us running activities and arts and crafts and horticultural therapy for the patients throughout the week. So there is always a place for them to come, to be involved in activities if they want to be, and to just, if they don't want to be, just to come and sit in our beautiful garden in the different rooms that we have, in the different spaces within the garden. And I apologize, I haven't got a slideshow for you today, but all I will say is that we are open, that you can come and visit us on the 17th of July for the National Garden Scheme in our Salisbury garden. If you're not local to Salisbury, then there are other NGS open days in our other gardens, and the best place to find out about those will be on our social media. We're also having a 10th anniversary celebration this year at Longford Castle, which is just outside Salisbury, and that is on the 19th of June. And tickets are pre-booked, and you need to do that again online through our social media channels. So I'll talk to you a little bit about spring gardens and what's happening in the garden at the moment. Well, lots are happening in the garden at the moment because we've had all that lovely rain. So it's, thank goodness, because I was starting to get a bit worried, and I was starting to have to put the sprinklers on, which is not ideal. So what are we doing? We are keeping the weeds in check, definitely. So getting in those borders, and now that we've had that rain, the weeds are going to be romping away. What are we also doing? We're planting out our tender perennials. So I don't think there's going to be any more frost now. I've probably the kiss of death on that, having said that, but I'm pretty sure we are not going to get any more frost. So we're putting out our cannas, we're putting out our dahlias, we're putting out our agapanthus, our salvias. So lots of planting that we're adding into our borders and into our containers. So we're refreshing our containers. Those of you that grow tulips and daffodils in containers and winter bedding, now's the time to either put those containers to one side and get some. I always rotate my containers at home, but at work at Horatio's we have large planters that we can't move, so we have to take everything out. We pot it up, we keep it for next winter. And we add in our summer colour. So we start to put in our bedding plants. What I mean by that is our annuals that aren't hardy, that will suffer from a frost, but just adding in that colour so that there's interest all the time in the garden for patients to enjoy. So we put in our cannas and dahlias and lots of bright colours. What else are we up to? We're just busy tweaking our planting scheme really in Salisbury. So we've been there for 10 years now, so some of our plants have got a bit bullish. Some of them are taking over. And so I only joined the charity in December. So for me, as the garden comes alive, I'm starting to discover what we have got in the garden and what we've got too much of and what we haven't got enough of. So we're busy adding in and just cutting back and chopping back a bit some of the plants that have got a bit too carried away. We in all of our gardens, they're designed by some of the leading garden designers in the country. And in Salisbury, we work with Cleve West, who designed our garden, and he's very much still involved. He came to see us a couple of weeks ago. We spent several hours going round all through the borders, just talking about what we're going to add, what we're going to take out. So yeah, I've got lots to be doing, lots to be getting on with. What else?
I've got a question for you, if I may, Lucy.
Yeah.
You mentioned daffodils there. So I've got loads of daffodils out the front here, and my mum came up the other day and started tying them into knots. Not a big fan of that. It doesn't, well, aesthetically, it looks awful. Yeah. Also, if you're doing that, what the foliage is doing is it's putting the nutrients back into the bulbs. So if you're tying that up, you're stopping it doing that. You're stopping it photosynthesizing, dying back. So if you do that, I don't agree with that as being a recommended way. Unfortunately, with daffodils, they do look a bit scruffy. I always think if you're growing them in a border and you're going to see them, the smaller varieties are better because the foliage dies back quicker and they get taken over by the larger planting coming up. I think the larger varieties work better in sort of grass and drifts rather than in the open border. But yeah, no, I don't. And then then you could just cut them back, can you, for those as soon as they die? We say 6 weeks. So we say sort of 6 weeks. You can then sort of cut them back. Yeah. Top tip. Thank you. Yeah. So the same with tulips as well. I mean, tulips in the border, there are tulip varieties that will stay in the border and come back year on year, but quite a lot of varieties don't. So that can be a bit of trial and error as to which ones will come back year on year. And I suppose I suppose the other question I've got is in a lawn. James, I'm not sure if it was a question you're probably going to ask as well, but I've got a lawn with a few weeds in it, with some daffodils, some daisies, some bits and bobs. What's the best way to treat a lawn like that? Because everyone loves a nice lawn.
So you've got daffodils in your lawn?
So no, sorry, daffodils are somewhere else. Right. What did I say? Daffodils, I mean dandelions. Sorry.
All right, okay. Yeah, I mean, you can. I mean, probably it depends on how extensive the problem is, but maybe, you know, going out and spot weeding those, because thing with things like dandelions, they have tap roots. So if you break off a part of that tap root, all you'll do is it will regrow. So right, they are tricky ones to really. You don't want to be doing too much to your lawn as we get into June, because the likelihood is that we're going to get drier weather. Really, lawns need attention early spring and autumn. That's when we get out there, we scarify, we treat, and you put on.
When you say treat, do you mean like applying I've seen these weed and feed thingies.
Yeah.
Yeah.
So we don't feed in the autumn, we feed in the spring, because we want that lush growth in the spring. If you were to do that into the autumn, you'd get all this lush green growth before you go into the autumn and everything dies back. So you don't want that lush growth in the autumn.
Thank you.
Yeah, you have to be mindful if you are feeding your lawn that you need to make sure if it hasn't rained, that you need to water it quite soon. If it doesn't rain within the first 24 hours, you need to be out there watering. Otherwise, there's a danger of you scorching your lawn.
Right. Okay. Weed and feed, then water if no rain.
It is, but it is actually there's a new initiative that started a couple of years ago called No Mow May. So we shouldn't be mowing. We should be letting the grass swathes of grass grow long and letting those insects and birds and wild flowers start to grow. So yeah, I'm not a big advocate for neat lawns, and we don't have any lawns in any of our ratios. Thank goodness for that.
Yeah. James, I think that was your question as well, wasn't it?
Yeah, well, I can expand on that. How do you balance out sort of like looking after the aesthetics, not just a lawn, but a garden, without sort of like over mowing and taking out too many weeds, but also just trying to obviously encourage the local fauna to come and benefit from it?
Is this in a lawn or just generally in
the garden in general? Obviously, a lawn, my dad would mow it to death, but obviously that's probably not great for the local wildlife, is it?
No, I mean, if you either think it's the lawn, you're either going to have it cut short, and that's your ornamental section. But you could always have an area that is, you know, close to the house that you mow closely, but then you could have areas further away from the house that you leave long, maybe around the edge. It depends on the type of gardening style that you're looking for, really.
Very low maintenance on my end, I think.
AstroTurf, James.
Not that.
Take your lawn up and have a meadow, or put a meadow in.
Will, I think you had a question about wisteria.
Yeah, I'd be interested to hear if there's any secret thing that you can do to a young wisteria, about 5 years old, to try and get it to flower.
It's not flowering.
It's not flowering, but I've been told that it's hit or miss. It can take 50 years, you know, at worst for a wisteria to flower.
No, I would say it should be flowering now. So maybe it's down to your pruning regime, perhaps.
Okay. So we give it a good hard prune in the winter, and a very light one in the summer.
Yeah. So summer you're just cutting back some of the tendrils, so you're just keeping it in check. But yeah, maybe you're pruning it too hard. I don't know. Maybe that's what's happening. Yeah, we have wisteria in Salisbury. We have a white variety. Very nice.
Super duper. Anything else that I'm seeing? We've either answered all the gardening and investment questions in such detail that no one's asked any questions, or completely bamboozled everyone. Was there anything else, Lucy, that you wanted to add before we sort of wrap up?
Well, I'm just going to say that what else are we doing at the moment is that we are doing lots of gardening sessions with our patients. So we try to get the patients to get involved with gardening activities. So seed sowing is the perfect time now to be sowing our seeds. We sow annual flowers. We sow some perennial flowers. We also have little vegetable areas. So we've got tomato plants are ongoing. So we've already got tomato plants sort of like almost up to 1 metre in height. So they're doing really well with some little baby tomatoes on. So we've got every garden has a greenhouse, and we're fortunate at Salisbury to have a little polytunnel as well, just outside the garden. So we've got a lot of space to be growing plants, which we also then sell on to patients and staff and to visitors, but we will also bring to Longford, and there'll be a plant stall there as well.
Perfect. So I just wanted to add that we're also, I don't know if you know, Lucy, but we're talking, the team at Casterbridge are also looking to come up to do volunteering days over the, so, you know, us guys included with the rest of the team are also going to be coming up to get our hands dirty and help you out with that weeding, with the weeding duty. So maybe we'll see you up at the Salisbury Garden soon. But
yes,
I just wanted to say on behalf of everyone, thanks for the amazing work you do there, because it's, I know how valuable it is to the patients in the hospital. So thank you very much indeed. But thank you. Big round of applause from everyone on the
do come and see us, and I'll be able to bring it alive a bit more. Sorry, I didn't have any pictures for you today.
No, and if any of the clients listening or the guests listening on, you know, if you need any more information, you can't find Horatio's garden, do give us a call, and we can point you in the right direction to let you know open days, along for plant sale, etc. So do that if you're listening. So I think that brings everything to the end. If we haven't addressed any questions that you have, do let us know. Send either one of the team at Casterbridge or your financial advisor an email or a question. Thank you very much indeed for joining us, and thank you very much indeed for us intruding on your evening. We will be doing one of these again, probably sort of autumn time. Maybe you should come back and give us another autumn update. But thank you very much indeed for everyone. Thanks to James, Will, Julian, and indeed Lucy. So thank you very much indeed. Good night.